Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1M, as you know, is the first and only global virtual accelerator for technology startups. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. In support of that mission, we've been doing these roundtables for years and years and years. This is the 688th session. And we started doing these roundtables back in 2008. And we do probably about 45 to 48 roundtables per year. So it's a, very consistent program that has been part of the startup ecosystem of the world, because we do get entrepreneurs from all over the world. Today, we have a slightly different kind of program than what we have usually. We will do lots of Q&A, so you are very welcome to line up your questions and ask questions, and I will get to that. I'm going to spend some time first talking about something that is being discussed quite a lot in the water coolers and on the virtual water coolers right now. And I'll give you my perspective on 3-month accelerators. Now, 3-month accelerators have been part of the ecosystem now for quite a while. And Y Combinator was the first really successful 3-month accelerator, and it remains one of the most effective ones. They have extremely high rates of success, relatively speaking. They have produced a lot of unicorns, a lot more than the general market failure rate and so on. So in that sense, I would say Y Combinator is a worthwhile accelerator, a worthwhile 3-month accelerator. But there's a but, and I would like you to understand the but really well before you make the decision to apply to any 3-month accelerator, including Y Combinator. So here it is. The first thing that you have to be aware of is that these 3-month accelerators operate on a demo day focused basis. So at the end of your 3-month participation in the program, you are expected to participate in a demo day where you're going to fundraise. Well, some of these accelerators most of these accelerators simply do not have a great network of investors around them. So they have a lot of what I call dumb money investors attending these demo day events. And the accelerators are incentivized to say, oh, we got, 20% of our companies funded or 50% of our companies funded. So they don't care about the quality of the investors. Y Combinator is different. Y Combinator has a very, very excellent set of investors that come to their demo days. So if you do get to work within the Y Combinator framework and pitch at their demo day, the chances are you will be encountering very solid investors. And Y Combinator has a 98% rejection rate. So the chances of you getting into Y Combinator is very, very low. But let's talk about first I'll talk about Y Combinator separately because they belong in a very different category. But the vast majority of the 3-month accelerators expect you to be ready to present to investors in 3 months. My take on all this is that if you are starting from scratch, the chances that you're not going to be ready in 3 months is very high. Why? Because finding product market fit, finding a positioning that is a scalable positioning worthy of funding is a much more involved exercise. There's a lot of learning involved. There's a lot of market testing involved. You have to talk to a lot of customers. And sometimes, especially if you're working on enterprise deals as your primary market, enterprise software market, even getting a meeting with an enterprise CIO is going to take you 3 months. So what are you going to accomplish in 3 months that is going to get you ready to be able to pitch a fundable pitch, a funding-worthy pitch in 3 months at demo day? This is what one of the things that bothers me the most about this 3-month accelerator model is that you are expected to go straight into a funding cycle without first figuring out whether you should be fundraising or not. And I'm going to give you another really important point that you should keep in mind in this context, and that is blitzscaling versus bootstrapping. The 3-month accelerators are mostly operating on the assumption that they are feeders into the venture capital industry. Even if they bring you into angels at demo day and get you the first funding from angels, the expectation that they're setting with themselves, with angels, and with micro VCs who invest in these companies is that you are going to be blitzscaling. They're taking equity in your company. The compensation model of 3-month accelerators is equity usually. So if they take equity, they're expecting that their equity to become valuable because you are going to, become a fast growth company and exit so that their equity becomes worth something. And all follow-on rounds of financing are going to do the same thing. They are going to enable a big exit and building a fast growth company. This is not a given. Fast growth, hyper growth, blitzscaling, these are very rare. Companies don't grow at high velocity pace as a rule. What is a venture scale growth? What is blitzscaling growth from a metric point of view? Essentially, you're going to have to triple your growth. You're going to have to grow 3x the first 3 years, and then you have to grow 2x year 4 onwards. And essentially, this trajectory presents a $0 to $100 million revenue trajectory in 5 to 7 years. This is what blitzscaling is. This is what hypergrowth is. This is what high velocity venture scale startups are supposed to do. So the minute you enter the venture capital timeline, you have to execute at this pace, and it's extremely difficult to do, which is why if you look at the current situation in the industry, there are about 1,200 quote unquote unicorns, of which in the last 12 months, 330 have lost unicorn status. And what does that mean? That means that once upon a time, they had hit in a valued equity fundraising round, they got a $1 billion plus valuation. And then what does it mean to lose unicorn status? It means that 330 out of these 1,200 companies were not able to raise the follow-on round of financing at least a $1 billion valuation. So chances are they've all seen down rounds. Down round means the valuation has fallen from the previous round. So if it's a Series C valuation of $1 billion, the Series D valuation is sub-$1 billion valuation. Down rounds are looked upon very badly in the industry. Down rounds are very bad for everybody. It results in tremendous angst and tremendous pain in the fundraising round. Investors hate down rounds. Even entrepreneurs hate down rounds because their equity gets really diluted. And there's another phenomenon that kicks in gear when your company stops to grow at a high velocity and starts to have to take down rounds is this liquidation preference business. Liquidation preference really destroys your own personal ability to make money off an exit. The investors who come in later with these huge liquidation preferences end up taking a large share of the exit proceeds, and less are left for the earlier round investors, and even less for the common share and the entrepreneurs, the employees, and so on. So down rounds are terrible, but 330 out of the 1,200 unicorns have seen down rounds, most likely. The other unfortunate prediction that I'm going to make, this is the prediction, this is not data or actual metric. I think another 500 companies out of those 1,200 are going to see the same kind of non-performance, same kind of down round type of experience. And that's terrible. So by the time we are done, out of these 1,200 unicorns, it's not clear to me how many of them are going to become real unicorns. And real unicorns means an exit happens at $1 billion plus valuation. And that is looking less and less likely under the current circumstance. So all this is to help you understand why, if you go sign up for a 3-month accelerator, you're effectively signing up to grow at venture scale, going from 0 to 100 million in 5 to 7 years, which is hard to do. And then you have already given up 10-15% of equity against maybe $150,000 to $200,000, which is a very, very expensive round of financing. And then you are basically entering this constant pressure to go raise more money and to grow really fast, 3x for 3 years and then 2x for year 4 onwards. This is all very, very difficult to do. And if you just stumble into accelerators and put yourself in this high stress expectation, it is something that is going to be really difficult to get out of. Because the likelihood is that 9 out of 10 venture-funded companies fail to grow at venture scale, to grow with high velocity. So if you are one of the 9 and not the 1 out of the 10 that actually finds high velocity growth, if you don't hit your stride, you're going to fail. And I'll give you some examples of what failure means. A $10 million profitable company would still be a failure because you have entered the venture timeline. Venture is 0 to $100 million in 5 to 7 years. If you, in 5 years or 7 years, if you build a $10 million profitable company and you have taken venture capital, you are a failure. So be very careful about stumbling into a 3-month accelerator and entering this timeline, giving up equity and so on, without thinking through whether you can actually build a company, whether your business idea has what it takes to do something like this. So what is your option? What is your alternative? The alternative is actually bootstrap first, raise money later, which is the principle that we follow in 1Mby1M. We believe that companies should startups should bootstrap to validation, bootstrap to repeatability. If you can achieve repeatability, that is the key ingredient of venture scale growth. If you can get, your first 5 customers bootstrapping, if you can get your first 50 customers bootstrapping, and if you can figure out what is the repeatable customer acquisition strategy, and you can actually really grow real fast by infusing capital, that's a good time to go either apply straight for venture capital, or you can go to an accelerator and use their network to find venture capital. For this, if you are at this stage, you should apply to Y Combinator. Y Combinator does have a very good network. And if you can prove repeatability and use Y Combinator's network, you're actually in a very good position to swing for the fences. You could potentially become a unicorn company. Now, the question then you must be asking is, how do you get all the learning and all the mentoring, coaching, etc., that you need during that period that you're bootstrapping? And the answer to that question is you should work with a non-equity accelerator that does not operate in a 3-month compressed timeline, because you're going to take more than 6 months, 9 months, sometimes 18 months, sometimes 24 months to fully flesh out your concept, get the customers, the customers to use the product, give you feedback, iterate, and really build something robust as opposed to something, fragile and brittle. And the answer to that question then is, who is that accelerator? That accelerator is 1M1M. So if you want to apply to a top-notch accelerator that can bring you in contact with really solid investors in a 3-month program like a Y Combinator, you can use 1Mby1M as a pre-accelerator, and you can then go to something really high quality in the 3-month accelerator category. Now, bear in mind the fact that we could also take you directly to investors. We have our own excellent network of investors. You can go directly to investors through us as well without having to go to another 3-month accelerator. The other really fabulous point about 1Mby1M is we do not take equity. You can work with 1Mby1M 1 year, 2 years, 3 years, and really make serious progress in a bootstrap mode without parting with any equity. And that's immensely helpful and immensely founder friendly. Because the other thing that you have to keep in mind is that exit is rare. Large exits are very rare. $1 billion exits are incredibly rare. 96% of the exits that happen in our industry are sub-$100 million exits. And a vast majority of those are sub-$50 million exits. So if you want to make money off small exits, you have to either bootstrap to an exit or seed strap to an exit. And what is seed strapping? Seed strapping is taking small amounts of funding and going straight to an exit without doing the whole scaling within a venture funded timeline. You basically get to repeatability, get to validation, get to product market fit, get to repeatability, and really create the thesis for a high growth company. But instead of growing that company with venture capital, you go straight to an exit to a strategic buyer who will then take you through their channel, and the business will grow, but it will grow under a different owner, but you can create a lot of wealth doing that. And this is something we support. We will support you. If you want to build a unicorn, we will support you. We have built unicorn style companies, and we will support you if you want to bootstrap or seed strap to an exit. We don't care how you succeed. You can define what kind of success you want. Big, small, medium, win. Whatever kind of win you want is fine with us. But we want you to win. We don't want you to fail. We don't like this 9 out of 10 companies fail statistic. That is a counterproductive statistic. That is a statistic that makes entrepreneurs go through 5, 7, 10 years of their lives and then create no wealth at all. And that's not desirable. Okay, so these are some of the points that I wanted to make on why you should not go to 3-month accelerators. There are more points I would like to make, but let me first check. Do you guys have questions? You can ask your questions in the public chat, and I'll pick up questions from the public chat and start answering. While you're doing that, let me also give you some more points that are not desirable, not positive points for 3-month accelerators. The first of those points is about mentoring. Mentoring is effective if your mentor gets to know you, your company, what kind of test exercises you're doing. Is it validating? Is it invalidating? How to change the positioning? How to put one foot before the other. And that requires continuity. The problem with these 3-month accelerators is they have a whole, lot of mentors. They kind of take pride in that we have a great mentoring network. You come into our accelerators and you're going to meet lots of people. And you're going to talk, you're going to have superficial conversations with lots of people. That's not mentoring. There's no continuity. Nobody is vested. Nobody is taking real interest in your success. Nobody's taking responsibility for your success. So then this kind of mentoring doesn't help you build any long-term relationship or get any sustained, coaching, insight, hand-holding, guidance, whatever you want, whatever you call it. There's no sustained help. There's no long-term relationship. And that is not mentoring. That is a bunch of conversations with people who have done a few things before. They're not really taking any ownership of what they're advising you to do. The other problem with this premature scaling pressure is burnout. For 3 months, you are running like crazy. And you're spending a lot of time going to workshops and lectures and blah, 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 which is the social aspect and the speakers aspect of these accelerators. They're kind of crazy environments. You could be stimulated by that crazy environment, but it also burns people out because you are not done. After 3 months, after you finish your 3-month accelerator, you are not done. You're going to have to run for another 3 years. You're going to run for another 5 years. You're going to run for another 7 years, 10 years. So you can't burn yourself out in 3 months. You're going to have to run the marathon. The accelerator is making you run a sprint. And sprinting is not good conditioning for running a marathon. So don't burn out. Burnout is highly undesirable. So my take on how I have built 1Mby1M from a structural point of view is to absolutely not risk burnout. You do it at your own pace. And people's paces are different. People's energy levels are different. People's situations are different. In 1Mby1M, for example, we support people who are bootstrapping with a paycheck, which means you have a job that is 9 to 5 at least, plus you are, doing your startup in evenings and weekends, during the evenings and weekends. That's a lot of energy requirement. People can do so much, only so much. And then on top of that, people may have families to take care of and so on. So you have to recognize all that and not burn people out. There's a human aspect to it. There's a mental health aspect to it. All of these are important points. Another sad statistic that really bothers me is that in this, blitz scaling kind of environment, there's a tremendous number of divorces. 60% of entrepreneurs apparently who are following this track of, venture funded blitz scaling end up getting divorced. And there are a lot of mental health issues. There are depression issues, suicide. I mean, there's all kinds of dirty secrets of this blitz scaling from the get-go type of existence. It's very, very stressful. And I don't like to put that kind of stress on entrepreneurs. And that's something else that I like about bootstrap first, raise money later is if you have bootstrapped, even if it's taken you 3 years, you have bootstrapped for 3 years and you have come to a point where you can see that, okay, if I put in $1 million into the company now, I can predictably generate $10 million of revenue. And that is when blitz scaling makes sense. The example that I will give you from 1Mby1M, where we have done blitz scaling, but it is after several years, not in the first couple of years. In the first couple of years, first year, no funding at all. In the second year, $1 million in funding. And then, it started hitting, this is Freshworks, it started hitting paid customers before the $1 million funding round. And then the company ended up raising $250 million, about $250 million in venture funding. But it was not doing that in vacuum. it had already figured out the unit economics, the customer and acquisition costs, the go-to-market strategy, everything was validated when big money started coming in. And that's a situation there where you can actually run really fast. And I don't have a problem at all with supporting your unicorn ambitions. We can do that. But I'm going to ask you to do that with blitzscaling, with bootstrap first, blitzscale rate later, not out of the gate, not in 3 months. You're not going to be ready to start making that decision to blitzscale in 3 months. That's just doesn't work. It does not work. So you would actually have a high probability of getting into Y Combinator if you bootstrap first. Let's say you do it with us, with 1M by1M. If you get to a point like Freshworks did, where you have very good, understanding of your unit economics, customer acquisition costs, etc., and how you're going to scale, what you're going to scale, your TAM, that's when, if you go to Y Combinator, you will get in, most likely, even if it's a 2% acceptance rate, you would still get in, and you would be able to really use those 3 months to network with investors, with potential customers, etc., and really knock the ball out of the park during demo day. So that is, after doing this business, the startup, incubation, acceleration, bootstrapping, blitzscaling, all of this is my conclusion, is that you are better off bootstrapping first, blitzscaling later. And these 3 months accelerators are sending you off to do blitzscaling out of the gate and taking large amounts of equity in doing so, and really harming your entrepreneur journey trajectory. So this is my, let's say, lecture on the topic of why I would advise you to avoid 3-month accelerators. If you have questions, I'll take questions. If you have questions about any other topic, that's fine too, by the way. Any kind of questions is fine. The next thing I'm going to do while you're putting your questions in is you can also talk to me. You can let us know in public chat that you want to talk to me, and Maureen will put you in the panel, and you can definitely talk to me, not a problem. So while you're getting yourself ready to ask your questions and talk and so forth, let me walk through how to use 1Million by 1Million. Everything is at 1Mby1M.com. This is a global virtual accelerator. So anywhere in the world, you can access 1M by 1M and use the program. The premium program is our full acceleration program, where you get access to our case study-based curriculum. You get access to whatever you call it, strategy consulting, mentoring, coaching, whatever it is, on a regular basis, weekly basis. You can come and talk to me, ask your questions, remove your doubts. We can work on your pitch. We can work on your strategy. We do an enormous amount of strategy work, strategy consulting. So I did 10 years of strategy consulting before starting 1M by 1M. And that was mostly with large companies, because the big money in strategy consulting is working with large companies. But my heart was in startups, and I really wanted to bring this kind of expertise to startups. And that is the genesis of 1Million by 1Million. Investor introductions are part of the premium program, but please be aware that just as soon as you join the program, we don't take you to investors. You have to become fundable. And that is, when I consider you fundable, that's when you're going to get introduced to investors. We're not going to gratuitously send you to investors to get rejected out of hand. We also have a curriculum-only version of the program, which you can start with if you like. That's 1M by 1M Basic. That's a monthly subscription fee model. And a premium is a $1,000 annual membership fee, and there is no expiration date. As long as you keep an active subscription, you have to renew a subscription, which you can stay in the program for 3 years, 5 years, whatever you want. It doesn't matter. The basic program is $99 a month. So go to the website, look at what to expect from premium, what to expect from basic. I think somebody who's here had asked for one-on-one consulting. One-on-one consulting exists in the program. It is just a lot more expensive. It's $1,000 an hour. I'm happy to offer you 1 hour consulting, but you have to sign up, pay for it to book a slot. The free roundtables happen every week on Thursday mornings. So there are 3 more coming up in June. If you have questions about the 1Mby1M program after today's session, please contact Irina Patterson at irina@1mby1m.com. She'll be happy to get on the phone with you as well. All right, questions, anybody? Yes, no? No questions? Very shy group. Okay, well, if you don't have questions, I'm going to wrap up and close off the session. We do not have mentoring today, but normally we have entrepreneurs that we mentor. Jackie, yes, please. Would you like to ask the question in public chat or would you like to talk to me? Maureen can put you in the, okay. Maureen, you can put her, put Jackie on the panel. She's going to set up her audio. You can also put on your video if you like, Jackie.
Hi, can you hear me?
Yes, go ahead.
Okay, thank you so much for setting up this amazing initiative. I have been following and learning on and off for a few years, but I have a concept now that I believe I need your help for.
Okay.
I may have done things upside down, kind of. I went and got a patent, and I know it's viable because I am a subject matter expert in the field. I'm not sure how to proceed from this point. Can I join your program and get mentored and
Of
work
course.
with you? Okay.
Well, are you working in the technology industries?
I work in real estate, but it's an intersection between real estate and technology. That's what the patent's for.
Okay, so we call that prop tech. Is that what you're doing a venture in, real estate tech, prop tech?
Yes, yes.
Yeah, we do that. That's not a problem at all.
Okay.
You're very welcome to join the program.
Thank you. Thank you so much.
Zakia Dejara Arib, do you recommend seeking paid customers first before looking for funding for a startup? Yes, absolutely, I do. Very much so. Very much so. Anna, please, yes, you can. You're very welcome to ask the question. Do you want to talk? Do you want to be on
yes,
the
please. I only don't see where. Can you hear me?
Yes, okay, we can hear you.
Okay, I don't see where to put up a video. Thank you again.
Maureen will put you in the on the panel, and you can put your video on. There you go. Now you can put your video.
Oh,
on.
I see. Yeah. I can go either way. Thank you for having me. I like seeing faces, so I assume maybe other people as well.
Anna, where are you joining from?
I live in San Jose, California, and I am talking to you from my home. So I wonder if my project is any thing in the line of your company, what it is aiming to do. So I understand you help startups that are in technology. My field of work is in education. I did what you say, bootstrap, a small company that teaches kids online. It was not funded.
Online education is very much, we call it online education or edtech. That's very much within the tech sector.
But we don't have our own technology. We just use Zoom and the live in-person lessons. We do exist for about 5 years with a team of teachers and around 300 kids. But
so
that business,
what we call what you're doing is technology enabled services. That is part of our portfolio. So e-commerce, for example, people who sell online do not use their own technology to sell. They use other e-commerce platforms like Shopify, or there is a whole bunch of platforms. But we do e-commerce ventures because they're a technology-enabled service. The same with education, the same with healthcare. There's a lot of telemedicine and stuff going on in healthcare. We do all of that. Technology-enabled services, we do that whole range of it. So that's what you would fit under, is technology-enabled service.
And another question is that we have a non-profit side of our business, which is only now starting, which is actually the main thing that I need help with, because it's...
We don't do non-profits.
We don't do non-profit. Okay.
Non-profit fundraising and all that is different, very different from how we operate.
Okay.
We operate on the basis of customers' revenues and profits, and then funding as it pertains to investors trying to make money off their investments.
Yeah. So yes,
non-profit
they
is not
have
part
two businesses, we can say, the one that gives and the one that is supposed to make money and making money. So that one perhaps is up our avenue.
Yeah. So if you have something that is a for-profit, that's a fit.
Yes.
Non-profit is not a fit.
Okay.
All right.
Thank you.
Jackie, where are you joining from? And what about Zakia? Where are you joining from, Zakia?
Sorry about that. Can you hear me?
Yes, I can hear you fine.
My apologies. I'm joining from Madison, Wisconsin.
Oh, okay. Madison, Wisconsin. Excellent. Very good. All right. Anybody else? Any other questions? Zakia is in the eastern side of the US. Okay. What part of the east? Any other questions? Pennsylvania. Zakia is in Pennsylvania. All right. Okay. Anybody else? Any other questions? Last call for questions before I wrap up. Okay, folks, I will see you next time. And if you are joining the premium program, I will see you at the private roundtable on Wednesday. Bye-bye.
Thank you.